Something strange happened in the financial world this week. Banks were attacking crypto, politicians were arguing about how to regulate it, and markets looked like they might be breaking. But while all of that chaos was happening in public, something much bigger was happening quietly behind the scenes. New financial infrastructure kept switching on, and when you connect the dots between a powerful Wall Street trading firm, the White House, Coinbase CEO Brian Armstrong, and a crypto exchange gaining access to Federal Reserve payment rails, you start to realize this week's headlines might not be random at all. They might be signals. Signals that the financial system itself is starting to change. Because by the end of this video, you'll understand why all of these events from this week, Jane Street shaking trust in market structure, banks lobbying against crypto legislation, the White House calling blockchain strategic infrastructure, and new payment rails launching around the world, are all part of the same shift in how money moves. Let's start with the event that sparked a lot of debate this week. A Wall Street trading firm called Jane Street suddenly became a major talking point across financial and crypto communities. If you don't work in finance, you've probably never heard of Jane Street. But they move enormous amounts of capital across global markets. They're what's called a market maker. Market makers are firms that provide liquidity. They buy and sell assets constantly so markets can function smoothly. Without them, markets become volatile and inefficient. Jane Street also plays a role in the infrastructure behind many modern financial products, including exchange-traded funds. And since Bitcoin ETFs launched, firms like Jane Street have become deeply embedded in the plumbing of how crypto interacts with traditional finance. So when conversations about market structure and trading behavior started resurfacing this week, it sparked a much larger question. How much influence do firms like this actually have over modern markets? And how much of today's financial system is controlled by infrastructure most people never see? Another macro signal came from institutional markets. Some analysts pointed to liquidity tensions connected to large institutional players, including movements involving firms like BlackRock. When institutions adjust their positions in crypto markets, the impact can ripple through liquidity across the entire ecosystem, which is another reminder that crypto markets are now deeply intertwined with traditional financial institutions. While those debates were happening, another conflict was unfolding. The traditional banking industry is increasingly clashing with the crypto industry. Some of the biggest banks in the world have been publicly critical of crypto for years. Jamie Dimon, CEO of JP Morgan, has repeatedly voiced skepticism. At the same time, banks have been lobbying lawmakers to slow down certain types of crypto legislation, particularly around stablecoins and financial rewards programs. The concern for banks is simple. If people can earn yield through blockchain-based systems or move money through decentralized networks, traditional banks could lose deposits and control over payment flows. This week, that conflict became openly political. After a private meeting with Brian Armstrong, Donald Trump took to X and Truth Social and openly criticized major banks. Trump accused large financial institutions of trying to slow down crypto legislation in the United States. Specifically, he pointed at the delay surrounding the Clarity Act, a proposed law designed to finally define how digital assets should be regulated. The bill was expected to move forward this year, but negotiations in Washington have slowed progress, and critics say pressure from large banks may be one reason. Trump argued that Americans should be allowed to benefit from crypto innovation, and that banks shouldn't be able to block it. That moment signaled something important. Crypto regulation is no longer just a financial debate, it's becoming a political one. But the Clarity Act is not the only bill causing tension in Washington. Lawmakers are also debating another piece of legislation known as the Genius Act. The bill focuses on stablecoins and whether digital dollars issued by private companies should be allowed to offer rewards or yield to users. Some banks are pushing back hard against this idea, because if consumers can earn returns directly through blockchain-based financial systems, deposits could start leaving traditional bank accounts, which explains why the fight around crypto regulation is becoming so intense. At the same time, lawmakers are debating something even more controversial: whether the United States should issue a central bank digital currency, often called a CBDC. Some policymakers argue a government-issued digital dollar could modernize the financial system. Others worry it would give the government too much control over how people use their money. So another proposal currently circulating in Congress would actually ban the creation of a US CBDC entirely, which means the future of digital money in America may come down to a choice between two models: government digital currency or privately issued stablecoins. The Clarity and Genius ACTs, as well as the CBDC situations, are becoming political issues, and the political signals didn't stop there. Eric Trump also made headlines this week after speaking publicly about a new Bitcoin mining facility connected to the Trump family's expanding interest in crypto infrastructure. Mining facilities are the physical backbone of networks like Bitcoin. They secure the network and process transactions. The announcement reinforced something that would have seemed unlikely just a few years ago. Major political figures in the United States are now openly aligning themselves with parts of the crypto industry. But here's the part almost nobody has connected yet. Every headline this week: the Jane Street debate, banks trying to slow crypto legislation, the White House calling blockchain strategic infrastructure, and a crypto exchange connecting to Federal Reserve payment rails. Looks like separate news. But they're not. They're clues. Clues that the financial system may already be splitting into two versions. And in a moment, I'm going to show you the one development from this week that makes all of those clues suddenly make sense. Once you see it, the rest of the week's headlines stop looking random. They start looking inevitable. One of the biggest developments this week involved a crypto company called Kraken. Kraken's banking arm received access to a Federal Reserve master account. That may not sound dramatic at first, but historically, only traditional banks have had direct access to the Federal Reserve's payment infrastructure. Those systems power things like FedWire, which move enormous amounts of money between financial institutions every day. So when a crypto company connects to those rails, it signals something important. Crypto infrastructure isn't just sitting outside the financial system anymore. It's starting to plug directly into it. And this happened during the same week another story surfaced. Outages hit the Federal Reserve's ACH payment network, one of the core systems used for direct deposits, bill payments, and bank transfers across the United States. Millions of transactions depend on ACH every day. When disruptions happen, they remind people how fragile parts of the current financial infrastructure can be. Which is exactly why some companies are exploring systems that move money in real time. At the same time, regulators are beginning to prepare for that future. The Office of the Comptroller of the Currency recently signaled that banks may eventually be able to hold tokenized securities with clearer capital treatment. In simple terms, traditional banks could one day hold blockchain-based financial assets the same way they hold traditional securities today. Another quiet signal that the financial system is preparing for digital infrastructure. Meanwhile, some states are already experimenting. Florida has been exploring frameworks that could allow stablecoins to be used for certain government payments and fees. If implemented, it would mean blockchain-based digital dollars being used for official state transactions. Another small but important step toward integrating crypto infrastructure into everyday finance. And while regulators debate the rules, entirely new financial networks are being built. The Canton Network is experimenting with tokenized financial markets, including things like repo transactions built on blockchain infrastructure. Another example comes from Hedera. Payment experiments connected to the Hedera network are exploring how distributed ledger technology could support national payment systems and regulated digital currencies. Projects like HashSphere and Project Acacia are studying whether these systems could make financial settlement faster, cheaper, and more transparent. These experiments rarely make headlines, but they reveal something important. The financial system isn't ignoring blockchain or hash graphs anymore. It's studying how to use it. And then this week, another piece of infrastructure actually went live. Zebec launched its super app. The platform brings together payroll streaming, payment cards, staking tools, and digital asset management into a single system. The goal is something often called PayFi. Financial services where salaries, payments, and transactions move instantly instead of waiting days for settlement. Zebec has also been working with networks like Canton, alongside partners such as Lattice and MasterCard, to explore how blockchain payment systems could integrate with traditional financial rails. Instead of payroll moving every 2 weeks through systems designed decades ago, these platforms are experimenting with the idea that money could move continuously, and when you step back and look at all of these developments together, a pattern starts to appear. And once you see this pattern, something else becomes impossible to ignore. But here's where the story gets even stranger. Because while banks are publicly criticizing crypto, many of the same institutions are quietly experimenting with the technology themselves. Some are testing tokenized assets, others are building blockchain settlement systems, and others are exploring stablecoins as the next generation of digital dollars. So the real question may not be whether crypto replaces the financial system. The real question might be something else entirely. What happens when the financial system decides to rebuild itself using the very technology it once tried to stop? That's where the rest of this week's story becomes even more interesting. But here's where the story takes an ironic turn. While the United States is still debating how crypto should be regulated, other parts of the world are already starting to use the technology. Across Asia and other regions, financial institutions are experimenting with infrastructure built on the XRP ledger. Japan is exploring trade finance platforms built on the network. Cross-border payment systems connected to Ripple continue expanding. And some stablecoin experiments tied to regulated digital dollars are happening outside the United States entirely, which creates an unusual situation. Much of the technology now being tested around the world was originally built by American companies. But because US regulation remains uncertain, some of the earliest real-world adoption is happening overseas. One example from this week involved a large transfer on the XRP ledger. Roughly 200 million XRP moved across the network for a transaction fee that was almost negligible. That kind of efficiency is exactly why blockchain systems are being explored for global payments. But the experimentation doesn't stop there. Platforms like Uphold and Flare are exploring ways to allow XRP holders to use their assets as collateral while still earning yield. Systems like this begin to blur the line between traditional banking and blockchain finance. At the same time, Ripple's RLUSD stablecoin initiative is expanding experiments tied to regulated digital dollars. Some pilot programs are exploring how these systems could support payments and financial services across multiple regions. And in places like Australia, financial institutions are already studying how regulated digital dollar infrastructure could operate within their markets. And when you step back and look at all of these experiments together, which brings the irony back into focus. Much of this technology was developed in the United States, but because American regulation is still being debated, the rest of the world may begin using American crypto infrastructure before Americans are fully allowed to use it themselves. Back in Washington, policy signals are becoming clearer. The White House recently released its cyber strategy for America, which frames blockchain technology as part of national strategic infrastructure, alongside technologies like artificial intelligence and quantum computing. That language matters, because it suggests the US government sees blockchain not just as a financial tool, but as part of the next generation of digital infrastructure. Trump also publicly stated that he would defend the rights of American crypto holders to control their own digital assets, which reframes crypto as an issue of financial freedom rather than speculation. All of these debates ultimately point to a much larger question. What form should digital money take? One model is government-issued digital currency, controlled directly by central banks. The other model is private stablecoins, issued by companies but backed by real assets and regulated by financial authorities. The decision between those two systems could shape how money moves globally for decades. So when you zoom out, this week wasn't just a collection of crypto headlines. It was a glimpse into a system under transition. Markets questioning fairness, banks fighting to protect influence, governments racing to write new rules. And underneath all of it, the financial system is quietly rebuilding itself. New rails are being tested, new forms of money are emerging, and the next version of global finance may already be taking shape. The United States is still debating the rules. Banks are fighting to slow the transition. And meanwhile, the rest of the world may already be building the next system. This transition won't happen overnight. But weeks like this show how quickly the pieces are moving. And if you want to keep track of how those pieces connect, subscribe and follow the channel. Because each week we break down the stories shaping the future of money.